Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from TicketTacker. We're taking a look at the board, the TradeStation board. If we take a look at gold on the top left, 1834.80, up about $22, up 1.23%. Silver up $60 at 27.62. We're entering into a fast market condition right now in precious metals. And we are moving above the sell 2 level of 1831.32. The silver is at 23.63. It's up about 2.37 cents, 2.37%, up about 64 cents, completing the sell 2 target, as you see, of 27.65. If you've been following my live presentations here for the last few weeks, just the last few weeks alone, we've been recommending for our clients, basically our traders, and for your benefit as a courtesy here in TicketTacker to get long the silver at 26.20, 27.63. We're trading last, so that's a pretty nice return profit, and we're recommending, obviously, those that followed, use your judgment up here, lock in some profits. When the market offers the opportunity to do that, we want to take the opportunity. And when the market gives you this targets, when it completes these targets, it's a question of how you manage your profile, your position, your profit level, that pretty much determines how you do in here. So the VCPMI targets are levels that are used to lock in profits, to lock in objectives. And when the targets are accomplished, pretty much the system tells you to go flat, go neutral. Don't worry about where the market is going. You know, if you take out $1 or $2 on a swing trade, that's a pretty amazing return. You know, from 2,600 that we talked about last week, that's a amazing return on a trade. That's about $1, $1.70. It's about $8,000 move profit on a trade if you followed the futures contract. So when we get days like today, we take a look at pretty much where we are in the scheme of things, and we use it to lock in profits on the futures contract. That doesn't mean that I get out of my core position of my derivatives. So when the price accomplishes these targets, you use it to lock in profits on your futures position, but you can still hold on to your derivatives, as I am. Derivatives like Nugget, because I'd like the bang for my buck, so to speak, up to 22, up 3.5%, while the gold market is only up 1.3%. So I use aggressive instruments depending upon how aggressive I want to get in terms of how I manage the risk with the instrument. And I've been recommending to buy the indexes like GDX, which is a 1-to-1. It's up 1.69%, but it's up. It follows the move in the gold market pretty much. And also the mining shares. And so you have a tremendous amount of choices, instruments that you can trade when you're trading in the metal sector, for example. The futures contract is just one instrument to use. But if you're looking to build equity, if you're looking to manage risk and manage margin, we're doing pretty well by trading the futures short term and building swing and position trading in the derivatives. Let's just keep an eye on the market up here for a little while and see how it is reacting to these targets that are being completed in the futures contract. We have resumed the uptrend of the market after it tested the lower levels of the extreme below the mean. Last week we tested the low of 25.94 on just the 4th of February. That's 4 days ago. And we're at 27.58 with a high of 27.67.50. So what the market is doing here, as you can see, is it's completing the targets, the probability model, the targets, the reversion to the mean targets have been completed from reverting from the average price daily of 26.80 to the extreme below the mean of 27.65. So regardless of what the market does fundamentally or what chatter you hear on CNBC, these are levels that you want to lock in your balances in the futures contract, lock in your profits in the futures contract, but you can manage the rest of your position, as I said, into the bigger numbers, the bigger targets. So even though the daily targets have been completed of 27.65, we are also testing the weekly average of 27.77. Now, if we close above 65, 27.65, this resistance level becomes the support, a support level. Now it transfers resistance to support by closing above it. And it activates obviously the next target above, which we're looking at 27.77. If we get a close above 27.77, you're looking at 29.61 as the next target. So while we took out obviously the riskiest positions, which is in the futures contract, took a nice profit this morning per contract. We're waiting now for the market to give us a signal in terms of defining the trend momentum. And so I'm flat on the futures. The daily closing above 65 is flat. And then you begin to move into and work with the weekly numbers, which indicating the average to be at 27.67. I'm sorry, 27.77. And as you can see here on January 28th, the market making a low of 24.89 tested these levels, the weekly levels. The market did not have the supply to bring the prices down to test the 2336 level, and it reverted from the weekly by one level approximately at 2520. And it went up to 3035 and in a matter of days. And this is where we built the next resistance level that we are looking to challenge. Upon completion of this target of 3035, the market reverted to test the mean again. This is where the reversion to the mean occurs, reverting right back up to the mean. And as you can see here, the market comes right down into that average price. It gives a bearish signal weekly, obviously, comes down to the nearby targets on the daily and reverts from that level, indicating buyers showed up at a higher level of 2593, 2600, which is when we recommended basically our traders here. If you look at my video from, I think is Wednesday or whatever day last week, this was when we recommended to go long. And for those that went long, the targets have been completed on the daily. And again, we are waiting for the market to close about 27.77 to activate the higher targets of 29.61. If we don't get this move up, then obviously the targets of 2680 below and the blue levels become active. The initial one is the average from above. Now, you see here the silver market trading the supply and demand in this area that is in red. And the area in red, once again, is distribution of supply. This is where the algorithm tells you that this is where you can expect, upon completion of the target, supply to come into the market. So here's where it defines basically what to do up here, because the market is trading above the daily resistance level. $27.34. Up here, it is a short signal. And if you want to take the risk, you can go short up here or went short at 27.65 and take the risk on a close above 27.65. When the market trades above the sell two levels, the AI tells you to, first of all, be cautious because the momentum is bullish, and therefore the probabilities do favor that, because we've come back from 25.93.50 low, we have a bullish momentum going. And so the highest probability, once again, trades that it recommends is to buy the corrections. Now, let people that want to take the risk up here do it, and then they can trade the supply up here. But from a personal choice, the AI suggests obviously always to take the highest probability trades, and that is essentially in the blue level if you want to buy, and in this sell level if you want to sell. What you want to take a look at is where the price is in relation to the bigger numbers that we're looking at, which is the weekly numbers of 27.67. So we're pretty much trading right around the 27.65, 67, which is almost a harmonic relationship. The difference is that the signal is mixed. As the market comes up into the bearish momentum, it's moving against the bearish momentum. Now, what we want to see is obviously the action here that the market has in at about 7:30. If it closes below, it would be activating a short trigger. And it's up to you as a trader if you want to take that short trigger or wait, for the market to define a little more clearly up here the supply and demand, and it will define the next momentum direction of the market. And the path of least resistance right now is to buy corrections, to buy into the blue areas now. So what you see here in silver is a slew of support in blue, starting from 26.49, 25.95, 25.20, all the way down to 23.36. Again, if we close about 27.77, you're looking at 30.86 testing the previous high, and the upper end of this bullish channel that seems to be building is up, into that 31 area. The sell to level is 32.19 for the rest of the week. So let me reiterate this again. For silver, a close about 27.77 will activate a bullish weekly trend momentum with targets of 29.61 to 32.19. Let's take a look at the gold market here. 1837 last. And you see a reversion unfolding in gold into the targets daily targets 1823, 1832 that were completed, and trading above that daily pretty much is in the weekly signal that you see here was activated on the 4th at 1784.85. Not quite coming down to the weekly buy of 1775, but did activate very closely the monthly level of 1781. The key signal here is that the market, after coming down to 1784.85, testing the monthly by one level, it reverted right back up above the annual average of 1810. So it came down through that average, activating a bearish trend momentum, and came down all the way to where it identified where the buyers showed up. And the fact that the buy-in power was stronger than the selling pressure, or it became strong hands buying, it was strong enough to take the average, the market above the annual average of 1810, getting it back up above that annual average of 1810, thus activating an annual bullish trend momentum. And this annual bullish trend momentum identifies the 2164 target above that average. As you see here, what we're looking at is the monthly signals on the right of the chart for the rest of this month, and also the yearly signals on the left of the chart. The monthly signals activated again a buy signal from that almost B1 level, and it met coming down to 84.60 with a low of 81. You can say that the program satisfied the criteria, particularly when it closed above 1810, which was the average annually. And so now we have an annual bullish trend momentum again for the gold market. And the target above, which is the closest targets, are monthly 1874, 1942, 2035 is the sell to level. And eventually we're looking at the yearly target of 2164 back in the game. So you can see that this incredible tool has given me, as a self-directed trader, the directions, pivot points, targets, prospectively, annually, monthly, weekly, daily, for me to use as a trader. And, you know, the next question obviously is, when is this expected to happen? If we take a look at the seasonal tendencies of the market, what we are looking at is potentially the winter lows that were made obviously back at 1800, and we're moving into the seasonal rally that occurs into the springtime. And using the 360-day cycle, for example, that has put in that 2164 in place. If we use the monthly, the target is 1874 initially, short term. So we define pretty much where the trades are going to occur, or where the levels with the highest probabilities are going to occur, besides some wild speculation about gold going up to 10,000, or if it goes, great, I'll be there. I'll see you there for sure. But in between, the market is dealing with a lot of fundamental noise that skews the price discovery into what one expects, you might say, the market should do. Point in case is that as we came into this new administration, the expectations was very, very bullish for the price of gold and metals in general as a consequence of the stimulus policies that the Biden administration is looking to implement, which is to print as much money as the economy needs, particularly Main Street. And so with Janet Yellen on board, the expectations were that the market was going to go up in price. Particularly on the back of this Reddit phenomena, Wall Street bets phenomena in GameStop and all of GM, all of these other heavily shorted stocks seems to be what this new sentiment is challenging. And what we saw here last Monday, after the announcement the previous week of this potential buy-in demand that may spread into the silver market. And, we saw the silver go up to 30 something, and then collapsed to 26 from 30, $4 move collapsed within a matter of just days. And I even though I think we're dealing with a new level of energy in the marketplace that I think caught a lot of these hedge funds by surprise initially. I think is beginning to change the complexion of the market in terms of the players involved. And now it seems that technology has given the little guy the opportunity to, take advantage of a lot of these anomalies and be able to have these kinds of moves in the market. But those moves are not real moves. They're not based on what I believe to be a real driving force. It's more of a speculative buy and dump mentality. short-term mentality. And it did give, GameStop, obviously, or even silver, for example, the opportunity to trade into that 30 target range that was expected. But it was not strong hands. The market was not in strong hands. And of course, what we saw was this massive liquidation, panic selling that brought the market down to that under 26 from 30, 35. Now, what you're looking at is the real strong buying, the real strong hands, you might say, started buying down here again, because the prices will go in based upon these fundamentals that we have with the current administration, the stimulus package that's coming out, which I believe is just the beginning of additional stimulus that needs and is required sooner than later for the market. Instead of the expectations of what everybody or the herd or the masses were looking for in the metals, they have done completely the opposite. And that is exactly what the gold market will do from a sentiment perspective. If you trade the market short term, this is what to expect. If you're a long-term trader, a long-term investor, these corrections are gifts, are opportunities for you to add to your core position, which is what I believe you should do, because prices are going to reflect a much different environment economically as we move into the later part of this year. And the silver market is what some people call poor man's money. Silver in Spanish means plata. Plata means money. Silver, always in thousands of years, was considered part of the monetary system, so to speak, as a precious metals asset, particularly because of its application, not only in the monetary system as an economic indicator, but as an industrial indicator as well. The application is for speculation, it's in industry, it's in science, and now in technology. And as we move aggressively into this new economy, the application of silver is exploding exponentially. And I think you want to really pay attention to silver in a sense from that perspective, because the one element of demand that you want to watch for is the industrial demand. Tech companies use silver aggressively in the making of their products, in chips, computers. And they try to keep the market low, obviously, as low as they can, because there is a tremendous demand for industrial purposes, now for technological purposes. And when you're looking at silver at $27 an ounce, and you're looking at the gold and silver ratio, what about maybe 60, 70 trading, with as high as about 120. The cheapest commodity on the board is the silver market by far. It is a thin market, very thin market. So you have a lot of these big players manipulate the market like a wet rag, selling 10 to 1 futures contracts, paper contracts of supply that doesn't exist. If you take a look at the commitment of traders report, for example, it indicates that the funds have added to their short position somewhere around 35 to 38 billion dollars short. And this is, I believe, what the Reddit crowd, is looking at. How can you sell supply that doesn't exist 10 times in the futures markets to control the price? And this is what they do. When the price reaches these levels, they have the funds, they have the power, they have the muscle to bring the market down. The problem that they're having is that every time they bring the market down, the market finds new buyers, more buyers. And it is making these short sellers very nervous because what they don't want to is wake up the silver giant, and that is basically the industrial demand, that if the retail crowd pushes the price or begins to push the price above these critical levels, particularly if we close above 30, there's a very, very high probability that we're going to get a short squeeze. Massive buying in silver could occur. If you take a look at the cash market right now, you can't buy silver without paying a very substantial premium. And in some cases, I heard last week that there were up to a 50% premium, a $10 premium to buy an ounce of silver. So the cash market doesn't care that the paper market is down because they stop selling physical, and therefore the premiums, if you want physical, go through the roof. And if you add $10, let's say to 27.50, you're looking at 37.50 in the cash market. That is huge premiums, which indicate and confirm that we have a shortage of supply. And so I think the benefactor of this potential short squeeze developing here is going to be the silver market, particularly in the 1,000 ounce bars that are used primarily by industrial purposes, for industrial purposes. So these are the players that we're dealing with, is going up against Apple, against some of these big tech companies, that need silver to produce their products. The gold market is a little more difficult market to manipulate, but yet still they do succeed in doing that. As you can see here, this sell-ups here that are pronounced sell-ups where we get moves from 18 to 27, we get $30, $40 moves in a day, are primarily caused by massive short selling. And they bring the market down enough until it finds very strong buying hands, and we see the reversion unfolding. And we see in gold, obviously, now moving up towards that weekly target of 1866 and also towards that monthly target of 1874. And then we want to see what the market does when it gets up there. I think we're looking at more volume coming in here to the upside. The 1847 is also a 38.2% Fibonacci retracement. You can see from the high that we made of 2089 on August here, the market has been in a consolidation pattern testing, pretty much the buy-in demand that's in the market here. And this has been contrarian to what, it should be. What this tells me basically is that the 2089 price discounted a lot worse damage than was originally announced. And now the price basically is looking for confirmation, of that damage, or how much stimulus you might say is going to come in. And came down all the way to 1767. Reverted back down again, tested this level again as of the 4th, okay, when we came down to 1784.60, and now we're reverting it right back. So this is the second time at this level here that we've tried to test this market successfully. So you want to maintain your core position long. Obviously, in futures, there are no trades in futures right now. But your core position, you want to maintain long until 1874. And then we want to see what the market does, how it reacts at that level in terms of its supply and demand. Once again, 65, 67 in silver is the sell one target, and also the average weekly price of 27.77. We're looking for the market to trade about 27.77 and activate 29.61 as the next target. Picking up a little momentum here. $39.50 trading, fast market in gold. Silver 27.60 into that sell one level of 27.65. It's completed the target. It's giving you a few chances if you are long in the futures, to lock in that 27.65 in the silver. We just want to continue to watch the market patiently here, hold on to our core position long, and look for the targets to be completed now on the weekly and even the monthly targets. The dailies have been completed. our equity continues to increase here on the core position on the derivatives that we have. So you should be gaining quite a bit of equity on those instruments as well. What you will see is when the price reaches the target, the major target that has the highest probability, and in this case, the sell to level, is a 95% relative implied volatility to the mean. And that means that if the trigger point is activated, then you're looking at a high probability that the market could revert, as you see here, trying to follow that momentum. The challenge that the signal has is the support underneath, meaning the buyers underneath to contain this momentum. And so it's the probability factor into the sentiment or demand of the market that determines the direction, basically. Let's just continue to watch the market a little bit here at these levels. You can see the resistance. I don't think there is anything to be what I call concerned in the long side of the market, as I think that any corrections are going to be bought by strong hands. And so I continue to recommend to hold your long-term position, your core position, and look for targets of 1874 on the silver market. I'm sorry, on the gold market, 1874. The silver market, you're looking at 29 and some change as the target. Another $2 approximately on the upside. Once again, continue to hold your derivatives long. They are rotating or rolling over into this bullish trend, and they are leading the momentum of the market to the upside. So I think we're on the right direction here. Continue to hold you long. And also, thank you once again, ladies and gentlemen, for the opportunity to share this information with you. And please take care of yourself, take care of each other, and I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control here at Ticker Talker. And Stephen, this is an amazing platform you've built where basically not only do people get to follow right along with you and your pro traders here, but you're actually teaching as the day goes along. I mean, you see a pattern that meets one of the patterns you're looking for, you're either buying it, selling it, or you're flat. Tell us about it.
Well, we start at 8 a.m. and we go right to 4. And throughout the day, I have various different segments. I have a trading terminology segment. I also have questions where a lot of traders ask me during the day. They hold their questions for that period. Then I do mini webinars, but constantly as the markets are moving and live during the market hours, I'm calling idea generation all day long. But most importantly, I'm showing you how these patterns repeat themselves using the predictive analytics that I built.
Right. Well, so for instance, E-mini and the micros. These are two of the most liquid and traded commodities, and even the options that they lead into.
Sure.
There are so many different ways people can limit their risk by saying, you know, hey, you always had a hard and fast stop and a profit target for every single trade, right?
Every trade. So basically using the predictive analytics, the most important thing as a trader, you want to be on the right side of the market. And I'm able to identify these trends right before my eyes using the analytics that I spent 8 years of my life building. With that, I also have mathematical stops in place, so there's no guesswork. And I'm constantly teaching all day long and showing you what the next move is, why it's going to happen, and why this is going to be the move up and or down to anticipate. I also show how correlation studies affect the market with the underlying futures contract, with the underlying ETF, and trust me, it works.
Now, Stephen, a lot of folks put out calls, and then they kind of walk away when they don't have a good call.
No.
But every one of your entries and exits is on this system, right?
It's time-stamped right to the second, and people can see it, and people can follow me. They can watch it, they read the chat, everything's time-stamped, and it's right there.
And if they buy the high-end version, they're hearing you too.
Correct.
In other words, there's a chat that runs down the side. I think it's going to be color coded for buys and sells, and you're going to be even able to filter if you're somebody who you're not really so good at selling, but you're good at buying in and catching moves to the upside. I'm not talking about you. I'm talking about the folks out there that are in there. But some of those guys will want to filter out some of the down move things. Some will only want the down move things because, as you know, it stairs up an elevator down. We drop like a rock, and some of your stuff today predicted that right on the nose.
It was dead on. And so basically the color-coded chat gives me the ability for commentary, what I'm seeing in the market, what I'm anticipating to see. Entries and exits and stops are all different, various different colors. Very, very simple. And for someone who wants the higher grade package, they can get to see exactly what I'm drawing all day long or calling shorts in the market. Here you can see I have the sell signal on the Qs and we shorted the first bounce and the market dropped. Or the S&P futures, as we called this short here around the 12.5, and you can see we're printing new lows on the day. They get that, they get the audio, they get to see exactly what I'm doing all day long, and they get to follow me along the way.
You and I are into sports, so I'd say just like your son, who's a pitcher, just like your daughter, who's a soccer player, like you and I when we played football, it's muscle memory. Trading has a muscle memory too, except this is the muscle.
Absolutely.
For trading. So you've got to kind of develop that rhythm, and then if you get out of the rhythm, you might need that little bit of coaching that you get from the on-demand. And so I think those tutorials are going to be one of the biggest things here.
It establishes confidence as well, because as you're trading all day long, you may say, let me go back to that trade and let me see what I did or I could have did better and why I covered here when it really dropped more and I could have kept, kept on lowering my stop. But I felt, like you talk about sports, right? How many times the football players or soccer players, they go into film and it's constant muscle memory. Well, what I've developed here, I've been telling people for years that patterns repeat themselves over and over again. And the more you do this on a daily basis, the more the memory. And people now jump at me like, I know that pattern. I know it. I see what he sees. I'm shorting him. And they go, and so it's a great feeling. And it's at the end of the day when people text me,
I made 5,000. I made 10,000.
Well, whatever they made.
Yeah,
I mean, it's to me, it's just so rewarding because I 8 hours a day doing this. It flies by. I love it. I love the passion, and there's no greater joy than teaching people.
Right. I agree. Well, folks, you want to see more about that, about Ticker Talker and so forth. Click on the link below and we'll get that to you. Whoever's calling will get that to them too. But this is a fabulous situation. Love it, Stephen.
Thank you.
I think this is going to be a huge success.
Thank you. Thank you.
Go back in time 20, 30 years, day trading in general did not look like it did today. You didn't have supercomputers, you didn't have laptops, you didn't have your phone with apps on them that you could trade for free. You had to go down to the exchange and place an order. You had to know somebody, you had to actually know what you were doing. So kind of break down, Steve, since you've been there, you've kind of seen the technology change, you've seen the world change, I guess, back in the day when the dinosaurs were walking on the earth, how much different is trading today compared to, 30 years ago?
So when I was 16 years old, my father said to me, he said, I want you to take a day off from school. I go, oh, okay. And I want you to come to work with me. I want you to see what your father does every single day. I said, okay. So I took the train with him from Westchester into Grand Central and then took the subway. And then I got a little breakfast and then I waited for him and then I waited and then finally they paged my father, and next thing I know, I started walking up these stairs on the floor of the American Stock Exchange. And as I'm walking and I'm getting closer to him, I started hearing the roar of the floor. And I knew right then and there, I said, good Lord, this is something, I just felt it in my veins. Like, I saw people running around screaming like lunatics, paper everywhere, people, hand signals back then in the days of the Amex, on American Stock Exchange. And I just knew that this was something that potentially I would want to do one day. And then I went over to the New York Stock Exchange and then working my way up from a specialist clerk to a wire clerk to a member. And then going to the COMEX and seeing the insanity in the COMEX pit and walking by the oil pit or the silver pit. And then going out to the Chicago Board of Trade and looking what the 30-year bond pit was like. Insanity. Never knew how anything got done. people were buying here and selling here, and just it was just insanity. Cards and paper everywhere.
How did that even work though? Like, let's say I wanted to buy 1,000 shares of, GE or some company.
Mm-hmm.
Like, how did that? What was the process like? If you were a trader on the floor, what was that process?
I've seen technology my God, just jump so far. So when I was working on the exchange, on the American Stock Exchange, the orders would come over a printer, and you would hear go the dots, printing, and then you would rip it off and hand it to a broker, and it would say, buy, I just give an example, buy 1,000 American Express, Feb 50 calls, because the Amex did a lot of options, and then the broker would go out and place the order or bid for it in the crowd, and or drop the order on the book, and then on the New York Stock Exchange, you had brokers that would drop orders out, handwritten orders, and then there was in the post of the New York Stock Exchange, orders would spit out and called dot, and you would see it say, buy 10,000 Westinghouse 15 and an 8, and you would just take the order if you were a specialist clerk and put the orders in the book and write them by hand. Nowhere near what it is today. Everything is electronic. So you've seen so much has changed in the last 30. I'm 36 years in the industry, and then when I started, there was really no one doing upstairs trading, and this one gentleman, till this day, I'll maintain he was the one who pioneered it. He took me and 2 other guys and put up a pool of capital and let us trade his money, and in a condo overlooking the Hudson. And I took everything I learned from the people I met along the way, and we just started just picking up the phone and just calling guys on the trading floor, and just doing things manually. Now everything's done pretty much electronically. So it's a big change.
I'm sure you saw, like, let's say the market's crashing. Like, what are the emotions like? Obviously people are losing lots of money. People are making lots of money. You've got people actually, shoulder to shoulder fighting to get orders in, getting orders out. Like,
I was there on Black Monday, and the orders just kept on coming out. I never forget, because it was an XMI index, and we were getting orders to sell international paper like every 10 minutes in GE, and I just couldn't believe the amount of shares that were coming in to sell constantly. And you lived it, but when you're in that line of fire like that, you're just so used to it, though. You got to be professional, and but now today, when you see flash crashes, you just now it's all done electronically. It's really, if you look at the floor of the exchanges, well, the New York, it's like a ghost town, really.
Yeah, it's just, when we went to the New York Stock Exchange, it was. I feel like it's more so just a kind of studio for CNBC. They got their studio set up there. They got some other stuff going on. There's a couple stuff going on. We talked to a couple of different floor brokers. It's interesting to see, but obviously, technology is to the point that everything's so fast now.
So when I was out in Chicago, I walked by the S&P pit, and that was pretty insane. Eurodollar pit, that was monstrous. And now I think I was there 3-4 months ago, and there's like maybe 8 or 9 people in the S&P pit. And so times have changed, but it's it's good, because in the way that things are electronically done, and you get faster reports, and you know exactly how you stand right away and everything.
I just don't get how they actually kept track of all those papers.
Well,
how was there any kind of bookkeeping?
Well, sometimes
who knew who owned what?
Well, in the pits, you talking?
Yeah, I mean, just in general.
There was a big difference between being a stockbroker on the floor of the exchanges versus being a pit trader.
Yeah.
When those guys are screaming all day, and they, they're making sure every time they do a trade they hand it off, and then their clerk would have to go and match it right away, because you didn't want what was called an out, and then that could have been a problem. Like, let's say, you're out there, you're in the 30-year bond pit, you're offering 14s, and next thing you know, you're trying to sell, and you're thinking you sold them to somebody, but maybe he's a seller, and then you got to make sure that those clerks meet within minutes to make sure. It was pretty chaotic, but it got done, though.
Yeah, it's crazy.
But it got done.
See any good altercations? Was like hockey ever, a little...
Oh, yeah. I mean, I remember times when I would get an order, and I would have to. There was no running per se on the floor, and sometimes you see a couple of the old timers try to trip me up a little bit because I was walking a little bit too fast for him, you know.
Yeah.
But you saw the territory, you just look back and stare him down, just, you know, and that was it.
You know, technology, it opens up, it opens the door to trading to the entire world.
Right.
It opens the door to thousands and hundreds of thousands of traders and people that are investing, you know, on their phones now. You have apps where you can literally buy and sell, you know, instantly and do all this. So, I mean, it's interesting. What do you think, like, just in general, you think it's just going to keep expanding? Like,
It might just get faster. That's about it. I mean, the technology is here. I mean, there's only one way to route orders. I mean, I had a gentleman came to visit me, and next thing I know, I thought he was texting the whole time, and he's actually trading the S&P futures on his phone while I'm calling it out.
Yeah.
Right. He was literally standing where you were. And I'm thinking the whole time he's texting a friend, and I said, "Okay, it's Friday, 3:30. We got to go because I got to drive you back into the city." He says, "No, I still have a position. I'm almost out." I'm like, "You're trading the last hour? I didn't even know you were doing that. I thought you were texting." You know, so it was pretty funny though. But you know, I think that with the technology where it is today on the mobile apps, and you have people who still sit in front of desktops all day long, and now you know what we do, even the TickerTacker platform, we have people who follow automated trades. So we have professionals who have written algorithms, who have auto trades with verified performances, and more or less that they can hook up and sign up to be part of those algorithms and follow those leaders on those automated trading. So a lot of people are don't have time because they're working, but they want to be part of an automated strategy. So it's starting to really blossom. That's why when I designed TickerTacker, there were so many functions and things that I thought were needed in the marketplace, and that was one of them, auto trading.
Cool to hear what it was like trading back in the wild, wild west, pulling out the little pew, 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 and through the hand signals. So maybe we'll do a video later about the hand signals, but for now, I'm out of here. We're going to get some dinner. I'll talk to you guys later on.
Folks, John Najarian here with Steve Collegian, co-founder of TickerTacker, and here we are in Master Control. And this is unbelievable, Stephen, because this is your E-mini screen right now. Show me what you're looking at.
So basically, I built Indicator 4 with my own predictive analytics, and as a trader, you want to be on the right side of the market. You want to be able to identify trends, reversals, and positive, negative divergences. I'm able to see divergence patterns, sell signals, picking up patterns that I'm able to call in the
And you're able to draw right on the screen, and that goes right out to the customer.
Right to the user. The user sees it as I'm drawing, constantly hit it, erase it. I can go to the cues. I can see sell signals develop right before my eyes. First bounce on the 5-minute. You can see we just dropped 70 cents. And whether it's bonds, E-minis, NASDAQ futures, or any commodity, that gold, silver,
Any future, folks, you got to check it out. Check out our link below, TickerTacker, on the Market Rebellion site.
just dropped 16, 15. The square is going to get another push up. Russell TNAs. Russell just dropped 80 cents off the high. The TNAs dropped $1 off the high. Good job, Mark. S&P should get another push up here. Facebook now negative on the 15. Apple still negative on the 15 as well. All right, bonds look to cover the bonds are even to 02. S&Ps dropped 10 off the high. Okay, I think we got one more push up here. This square, I want to see the square. I don't know if it's going to drop to 57.5. It does. It's a gift from God, and it's a screaming buy. Diamonds setting up here. Diamonds, beautiful pattern. Diamonds, buy the diamonds here on this buy divergence. 312 to 312.65. Diamonds off the 15-minute. All right, this square is getting deeply oversold. You should be getting long here. You should get one more push up on this square, and then another push down to up to 15-minute. That 15-minute time frame is going to launch it later. Okay, everybody, welcome to Ticker Talker TV. I'm Stephen Kalajian. All right, we have the Dow now above the 31,200. The market is really way overextended here. Okay, there goes the square right back up. S&Ps, look to sell S&Ps, 94.97 if you're long. The buy divergence, look at the 15-minute time frame on the diamonds, right? This is a huge buy divergence. You're getting oversold into the positive MACD here on the 15. Look at that. Look at that beautiful bull flag. You got to be crazy to be short. And there goes the square. Square is going to rally. Roku just reversed negative on the 15. Same thing with Facebook. Still have about 1,700 advancing stocks over declining stocks. Look at that pattern right there. Spiders are oversold on the 15. You got to be really careful here to be short. Look at the 15-minute time frame. You're in single digits here. There goes the S&Ps. See, Robert, getting oversold into the positive MACD. This is why the S&Ps were short up here earlier when they were making new highs. Do you see that? I don't know how my number gets out I swear to God, I don't get it. How my phone number gets out to these. Wow, look at Twitter go. What happened with Twitter just now? 58. Just ran $1. Wow. There goes the S&Ps right back up. TQs, good job. Sell the diamonds 80 or higher. Something just came out in Twitter. So the square pattern. Let me just get back here. Trying to get it. Hold on. Square just rallied $1. Okay. All right, what's going on here? So Square got short a bunch of times here. Okay. This was the pullback off the 5, and then it rallied to 62, 64. Now you're pulling in. But now any push up on Square is going to make a lower high. You got the 15s turning down, the negative MACDs. So when this pulls up, pushes up, it's going to get another push down to set up on the 15. I want to see these get into the 25 to 50 range, preferably 25. And then you're going to set some bull flag up, and this thing is going to rip the Square later. Okay. I don't know what just came out in Twitter, but it ran $1, dropped $1. So looking at this Square, you got a buy divergence. Remember, getting oversold, deeply oversold. So that's why I said to buy in that range. It just ran about $1.30. Okay, if it pulls in, it's even a bigger buy, more. But then if any push up, should make a lower high, an LH, lower high. And then when these work off this oversold condition to this negative MACD in the 15s, I expect another push down. But if you're long, you can start scaling out 80 or higher here. And then once we get another push down, that push down should set up these 15s like this into this huge buying pressure, positive MACD, set up a monster bull flag, and then rip later. Rip. I mean rip. You want to take a long here on Twitter, go 57.80 to 58.30 Twitter. Hey, sell this Twitter here, 58.15 or higher. Ernie, sell this square, 261 to 262 range on any long. All right, S&P, there goes the square. Just rallied 3. Okay, S&P's, let's see if the market's going to reverse here. Bond should drop. Okay. All right, square, I told you what square is going to do, right? Ran 3, it's going to drop now, it's going to make a lower high, and it's going to set up. So I think this next sharp pullback here on the square should really do it here. Okay, see the square? Beautiful. Just drop 2 on that sell divergence. Okay, so okay, I know these patterns. Okay, Apple getting kabooshed, S&P's about to reverse negative, Nasdaq futures. Okay, My bonds should drop. S&P is getting cabooshed. All right, this square is going to drop. I'd like to see it get down to the 58.5, and then we gotta be all over on the long side. Those 15s are going to set up really nicely, though. S&P is getting cabooshed. Okay. Okay, that square got down to 58.40. Dropped almost $3.50 on that pattern, and then we should have reversed to go long it. Remember, this ran 2. All right. Okay, let's see here. Jesus. AMD was a good buy here on the double blue pullback. $88.91. Just rallied 50. Now I want to show you a pattern here. Okay, so again, I'm going to show you a pattern here in Boeing. So Boeing, okay, you see the MACDs are positive on the 5th. Is this right, Boeing? Can't be right. Wait, let me just see something here. I think I got a problem here on Boeing. Oh my God. Ernie. Yeah, you got to be really careful here. You left dailies up on things.
You fixed it?
Yeah, you got to really just check them. Okay, I missed that Boeing because I had a daily up right here. You got to really check these, Ernie, every day when you refresh if you can. Okay, this one said a monthly up here. This one said a monthly. I had to change it to a 1 hour. Well, I'm telling you what it was. So if you look at Boeing, got oversold into this positive MACD, and then Boeing ripped from the 09 and change. It got down to the 0882, and Boeing ripped about 0882, 9, 10, 11, about $2.50. Roku getting way oversold here. Roku on the 15. Nothing going on in gold and silver. All right, look to buy the TNAs here, 97.30 to 98.30 TNAs. Look to buy the Russell here. Look to buy the Russell 224.10 to 225.10. Should get a really sharp push right back up again. TZA's got a bear flag setting up. S&P's and NASDAQ futures just flipped negative, so you have a disconnect now. The square is going to go
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.